Hi, everyone. It's Leah. Welcome to $1,000 Startups, Session 5, Unlock the Credit Multiplier. What does your credit score determine? A lot of folks don't know just how powerful your credit score is and how much it can either help or hinder you. It determines your credit rate on car loans, credit cards, bank loans, mortgage loans. It also determines whether or not a deposit is required when you're renting a house, apartment, or car, or if you turn on your utilities, the amount of deposit. It helps determine your insurance rate on home, auto, life. Additionally, in today's world, when you apply to a job, particularly a salaried position, it determines whether or not you're going to get that job. And it determines, of course, where an application for credit is going to be approved or disapproved. There are 5 credit tiers. Each one of those tiers comes with a set of rules that governs it and determines just how much credit that person is going to be eligible for and what they're going to pay for the privilege of having a credit card or having some type of loan. At tier 1, that score is the very best, and it goes from 760 to 850. You get special interest rates when you're at this tier. Tier 2, it's still very good, and you don't have any problem qualifying, but you don't receive the best or special rates. Tier 3, 600 to, or 660 to 699, no problem qualifying, but you're not going to get a good rate. Believe it or not, tier 4 from 620 to 659 is the average. That's the average credit. And at this rate, you don't automatically qualify. Tier 5, you typically don't even qualify for credit without a cosigner. Just by raising your score 1 point. So for example, look at tier 1. You start tier 1 at 760. At tier 2, 759. So that 1 point that takes you to 760 determines the amount that you're going to pay in finance charges and what you're eligible for and what rate you're going to pay. That's a big deal when you consider it's 1 point. So having a credit score of 760 and having a credit score of 850, 10 times out of 20. No, I even said that wrong. 10 times out of 100 doesn't make any difference. So if you're getting close to the next tier, some of the things that are in this class today are going to show you how to push your credit score up and get to that next level. It's important to understand that there's 5 types of information that the FICO score registered, and that's the federal something Isaac. I can't even remember what it stands for, but it's your FICO score. So the first is your payment history. So it's how timely you pay your accounts. Do you pay the amount that's owed at least? And historically, have you always paid? So 1 day late can move this score the wrong way. Utilization. This is your balance to limit ratio. So that's not necessarily intuitively obvious what that means, but we're going to look at that a little later. Your length of credit history. So the length of time each account has been open and how often you use those accounts. So 7 to 10 years is a good length of credit history, especially considering closed and negative items that fall off your report after a little bit of time. Typically, negative items fall off at 7 years, but having a good credit history going back 10 years will really, really benefit you. So this is a good time to be starting to clean it up if you need to. Recent activity. So what's looked for here, and it's only 10%, but that 10%, remember that 1 point difference, this could be it. If you've applied for a lot of credit in the last 6 months, or if you've had delinquencies, or if you've had a negative increase in your balance where you've run up your credit amount that you've borrowed significantly, that can really shave off those few points that you need in order to either stay at the tier you're in or prevent you from getting to the next higher tier. And finally, this is one that seems to be the most surprising. It's not just credit cards, but it's the mix of credit you have. A good credit mix means you have at least two different types. For example, a mortgage and a credit card, or a vehicle loan and a credit card, or an installment payment and a credit card. So don't apply for multiple types at once. However, do try to have at least two different types of credit accounts. So what if you don't have a credit history, or you have a credit history that you're not particularly proud of and isn't something you'd want a new employer to be looking at and evaluating you on? So step one, make sure you've got a checking account. And if you're getting a paycheck or receiving any kind of benefits, get direct deposit going right to that account, tying your checking into your direct deposit. Apply for a credit card from that bank. Now, sometimes if your credit score is like at tier 3 or 4, you might have to get a secured credit card. That means you've got at least as much in that bank, and you've got a limit to it, as the credit card will let you put on credit at a time, so that banks are assured of getting their money back. Then link that credit card that you get from that bank to your checking account. Use that card, but pay off the full balance monthly. This runs the effect of ratcheting your score up a little bit, maybe 1 or 2 points at a time, but over the course of a year, it can make a significant difference. Just don't ever charge more than you can afford to pay in that month. So here in class, we've been playing a game with our avatars. So in order to raise either your score or your avatar's score, here's what you want to do to get it to the next tier. Don't miss a payment, not even 1 day late. If you have any pending collections, so something that's been written off and sold to another collector, address those. Pick up the phone and call the new holder of your delinquent collection and make arrangements with them to pay that off. Defer your major charges and purchases, and don't change insurance company if you want to go up to the next tier. Not right now. Get to the next tier first. Pick the card, if you have credit cards, with the lowest balance and pay it down to 0. Now, conversely, if you have one credit card that has a ridiculous interest rate, pick that one first. But you'll see when we look at some of the examples that getting as much credit that's unused as you possibly can really moves that credit score up fast. Once you pay a credit card balance down to 0, call the credit card company, whether it's Target or whether it's Amazon or Bank of America, and get the credit limit raised. Tell them you're getting ready to make a big purchase and you want your credit score raised. Then start charging and paying the balance monthly, but keep that credit limit on that card. Then start to work down the balance on the next card. What if you've fallen behind, or your avatar has? Prioritize your current payment and your missed payments. However, your credit score isn't as important as making sure, if you're renting or if you're paying a mortgage, you don't want to get behind in that. It's better to take a hit in your credit score than to be homeless or to put your housing at risk. When you fall behind, have your avatar talk to his creditors and make certain you or your avatar only make commitments that you can keep. Do not, under any circumstance, and I will say this again, do not, under any circumstance, let your avatar or you go to a credit relief service. They do not do anything for you that you can't do for yourself. And in fact, going to them can cause you to pay a higher amount because they've got to get paid too. So let's talk about your annual credit report and the importance of that credit report. You probably know that there are three major reporting agencies. So these are the three big ones. Each of them calculates your score just a bit differently, and they keep it very secret. They don't want you to know just exactly how they calculate it. What you might not have known is that lenders and creditors are not required to report to all three credit bureaus. Sometimes they're required, depending upon who they are, to report to two, and sometimes only to one. You, however, are entitled to a free credit report from each of these three annually, or anytime you're turned down for credit. If you're turned down for credit, you immediately want to request a credit report and see why so that you can address it. Here's how you go about requesting a copy from each of those credit bureaus. These are instructions 1 to 7. They're replicable. So if you haven't checked it in a while, like more than a year, and you don't have any idea what your score is, it's okay to go ahead and request it from all three agencies at one time. And this shows you how to do that. However, that last instruction, number 7, shows you how to get into a cycle where every 4 months you're checking your credit score from a credit report from one of the three agencies. Does that make sense? So you want to have consistent viewing of your credit score, because it just takes one little mistake to really put you in a bad situation as far as your credit is concerned. Review your credit report and correct the credit history. Remember, correcting your credit history, the onus is on you. Now, let's go through the process of doing that. When you go, if you haven't looked at your credit report or sat down and read all the pages of it in a while, please don't be surprised if you find at least one substantive error. Most people do, particularly if you have a last name that's common. You will very often find that someone has credit reporting information that's been reported against your credit report, or if they have a social security number that's one digit different than yours. You might not even be able to see what that is, but you want to get it off of your credit report. As I said before on this first bullet, for pending collections that haven't been addressed, contact the collection agency and negotiate a settlement. The account has to show paid and closed before it can show that on your credit report. And it's going to be up to you to make sure that that collection agency sends that information to the credit bureau, but make sure they send a copy to you as well, so that you have something to use if for some reason it doesn't get picked up by the credit reporting agency. This is what we alluded to before about the 7 years. Public records, including foreclosures and civil judgments, should be removed after 7 years. If you had a bankruptcy in your past, or if for some reason you had a civil judgment and it's more than 7 years old, often you have to go request that it be removed and cite that 7 years is typically when it's removed. Another thing that's very important is if a job that you held for a certain amount of time, even more than 6 months, is not on there, send a proof to the credit bureau that's not showing it, such as a W-2, so that they get it on there. When people are looking at your credit history and trying to make a decision about you, they will look to see if you have gaps in your employment history. And if you do, then that are not really gaps, they're gaps of omission of paperwork, you want to fill those in. Verify that your personal information is correct, particularly things like your address and your date of birth. Make sure that they're right. You would be surprised. Things can be right on one credit report, and then the next year they could have changed because of misreporting by some other lender or agency. Verify that the accounts that are shown on there are your accounts. Make sure If you find something that's a problem, you have to address it with the creditor first. You can't go directly to the credit bureau. If there's a creditor involved, you have to get in touch with that creditor and get them to report it to the credit bureau, but follow up and make sure they do. Let's talk for a minute about collection accounts. If you have an account that went into collections, meaning you basically defaulted on it and they didn't think they were going to get your money, or this is done all the time with mortgages. So mortgages are often, after a couple of years, bundled and sold to another lender. It can happen that the lender that sold them doesn't close out your account. So now it looks as if you've got two mortgages with two different mortgage numbers, with two different mortgage companies. Now that can cause no end of trouble. So when you see them, even if it's not a collection account, if it's just a mortgage account that hasn't gone into collection, they do sell those to others. You want to get the one that's no longer the one that you're paying to or supposed to be paying to. You want to get it off of your records, so you will have to contact that lender to get it off of there. However, if it's a collection account, it's the same thing, but you want to look at the dates, because you want to make sure, if it's a collection account that you're going to try to negotiate on, you want to make sure you're negotiating with the collector who actually owns your account today, and not with one that used to have it. And if it's not off of your credit report, it's going to look like you didn't negotiate it. So you have to go back to that lender and get it removed. I'm going to say this again and again. There are many organizations that sell credit repair services. Now, some of them will actually give you something. For example, they'll give you a free credit report or let you check online and get immediate results on what's your credit and your credit history and what's your credit number today, like Credit Karma. But then they've got to make a living too. So they'll try to sell you other services or recommend other credit cards or try to sell you some type of insurance. Just understand that you don't have to buy those things. That's just the fee they're trying to earn by selling you something else. So they're giving you something and they're trying to sell you something. That's not unfair. However, let me say it one more time. Do not pay a credit repair service to fix your credit. They do nothing you can't do for yourself better, cheaper, and more thoroughly. So at this point, for your avatar, you know that avatar's monthly number, which is what? The same as your monthly number. It's the number you need to be solvent. In other words, to pay your bills and put food on the table. You've identified at least one opportunity to reduce that number, and you know his or her credit score. You've also given him the opportunity to identify a side hustle or go for a specific goal, like a promotion. So here are the little tools that I talked about. This tool is pretty interesting, and it's for one of the highest numbers that are associated with your credit score. It's called the credit multiplier. So this avatar, or this person, in January, their credit score was 720. Not bad, pushing up toward tier 1. But the credit multiplier was 30% of their credit score. So it's estimated to affect about 216 points, because it's 30% of the credit score. So this person had credit card number 1, had a limit of $3,000. They had a second credit card. It also had a limit of $3,000. So their limit was $6,000. Their balances on credit card 1, $1,548. On credit card 2, $571.50. Their total is $2,119. So on credit card 1, it was 51.60%. On credit card 2, it was 19.0%. And you really want to get this down to your balance to limit ratio being as low as you possibly can. You want to say you have a lot of balance. Okay, so let's move over to February here in this example. This person went and got credit card 3, and they got a limit of $2,000 on it. Well, that limit of $2,000 automatically pushed their total points up for their credit score to 219 points, but it affected the overall, and their credit score is now up to 730 just by adding $2,000 of credit that they haven't used, because when you look at the credit card balance, it's at 0. So just understanding how this works and understanding you can go get a credit card. You don't have to carry a balance on it. You can charge on it, pay it off at the end of each month, and it increases your credit score from doing that. This is a credit multiplier, and one of the things that you have control of, as long as you can get a credit card or some other line of credit that you don't need to really use and carry forward right now. You're just using it as a credit multiplier. This is an example of a loan amortization schedule. This is what you would see if you had a mortgage or a car payment. So let's look at the first 3 payments. First, they always have the date, and then they have the beginning balance. There's a specific scheduled payment of $307.30. If you make no extra payment, your total payment is still $307.30. Now, look what happens to that principal. The first month, only $243.80 goes to the principal, and $63.49 goes to the interest. The next month, because you've paid down a little bit, it's gone from $9,844 to $9,600. A little bit more goes toward the principal, so $245.37, and a little less goes to interest. You do that month over month, and you finally get to the end of the loan, because this was a 36 payments on this loan. You get to the end of the loan, and you're not going to owe anything. You've paid off, in this case, it was a vehicle. However, can you imagine what happens if you can put in, I don't know, an extra $25 a month on the payment? Then your principal goes down even faster, and your interest, what you're paying in interest, goes down faster. So this is a way to plot out how you can go about doing it. For example, you might be able to pay a loan like this off by paying twice a month instead of only one time a month, if you're paid every 2 weeks, or if you can afford to pay it every 2 weeks. Or say, each month I'm just going to pay an extra $25. It will really pay off over the long run and the life of the loan. So with that, let's go get busy with our avatars. If you have any questions, be sure to let me know.